You ever get that feeling that you're living in a completely different reality from what you see on the news? You hear that the stock market is booming, hitting all-time highs. But then you look around at your own life, at your community, and it just doesn't add up. Well, today, we're going to dig into that exact feeling, this massive disconnect, and try to figure out what is really going on. Right? This is the central question. It's the paradox that so many of us are trying to wrap our heads around. How can Wall Street be throwing a party while Main Street is just struggling to keep the lights on? It feels like two completely separate worlds operating at the same time. And yeah, look at this. It lays out those two worlds perfectly. On one side, you've got the triumphant headlines we see flashed across our screens every single day. But on the other side, well, that's the reality for millions. Prices for everything are going up, families are buried in debt, and local businesses are closing down. The two pictures just don't seem to belong in the same universe.
So, to really get what's happening, we have to talk about what the stock market is supposed to be. For the longest time, it was seen as a kind of mirror, It was meant to reflect the health of the real economy. Real companies making real things, hiring real people. But as we're about to see, that mirror is completely shattered.
This quote just hits the nail on the head. The very tool we all use to gauge how things were going is now giving us this warped, distorted image. What we're seeing isn't a reflection of real economic strength anymore. It's something else entirely. It's an illusion. So just how big is this distortion? How far from reality have things actually gotten? Well, prepare yourself, because the numbers we're about to look at they're staggering. They almost don't seem real. $4 trillion. Just let that number sink in for a second. This was, at one point, the valuation of a single company, the chipmaker, Nvidia. $4 trillion. And just to try and wrap our heads around that, think about this. One single company that makes computer chips was valued at more than the entire economic output of Japan, a nation of 125 million people, or more than all the physical farmland in the entire US combined. It tells you that something fundamental has shifted in how we define value.
And look, this isn't just a story about one company going wild. If you zoom out and look at the 7 biggest tech companies, what they call the Magnificent Seven, their combined value is hovering around a mind-blowing $19 trillion.
And this is the part that just breaks your brain a little. Just 7 companies are valued higher than the combined economic output of Germany, Japan, and India. We're talking about 3 massive global economies, billions of people, countless factories, farms, and services, and yet 7 tech companies are worth more on paper. This isn't logic. This is something new.
So, the big question is, how did we get here? Where did all this money even come from? To get that, we've got to look under the hood at the machine that created it all. We need to talk about the money printer.
For a long time, money was connected to something real, to gold. But after 1971, that link was broken. Money just became paper. But the real, game-changing moment came after the 2008 financial crisis. To stop the whole system from collapsing, central banks around the world fired up the money printers like never before in history. They did this through something called quantitative easing, or QE. It's a really fancy term for something shockingly simple: creating money out of thin air. We're talking trillions and trillions of dollars, not physically printed, but just created on a computer with a few keystrokes. Boof, new money exists. So where did all this brand new money go? Did you get a check? I didn't get a check. No, it was pumped directly into the financial system, to the big banks and large corporations. And this is something called the Candy-Tellin effect. Basically, whoever is closest to the money printer gets rich. They get to spend all that new cash first, buying up assets like stocks and houses before all that new money makes prices go up for the rest of us. And this absolute flood of cheap, easy money created the perfect fuel for a machine designed to do one thing: pump up stock prices. It's called the stock buyback, and it poured gasoline on this already raging fire. Here's the playbook. It's a simple 3-step process. Step 1, companies borrow billions of dollars at almost 0% interest. It's practically free money. Step 2, do they use it to build new factories, hire more people, or raise wages? Nope. Mostly they use it to buy their own stock off the market. And step 3, with fewer shares out there, the price of each remaining share automatically goes up. It's simple supply and demand. And that's why this analogy is just so perfect. A stock buyback makes the company look incredibly healthy on the surface. The stock price soars,
but it doesn't actually fix anything. It doesn't create any new value or make the company fundamentally stronger. It's just a financial trick, a fresh coat of paint on a crumbling foundation.
Okay, so we've been talking about trillions of dollars in corporate finance, but this isn't just a numbers game. This system has profound, real-world consequences for all of us. It has literally created a two-tiered economy, fundamentally reshaping who wins and who loses.
In this chart right here, it tells the whole story in one simple picture. Because all that new money flowed into financial assets, people who already owned things, stocks, real estate, etc., saw their wealth just explode. But if you're someone who relies on a wage, a paycheck, your income is barely budged, especially when you factor in inflation. This created what they call the Great Divergence.
And this isn't abstract stuff. We're talking about homeownership becoming an impossible dream for an entire generation. We're talking about young people finding it impossible to save any money. Retirements that people work for their whole lives are suddenly fragile. And that gap, that shadow of inequality, it just gets longer and darker across the country.
So where does this all lead? Well, according to the sources we're examining, a system built on financial engineering instead of real production has a fatal flaw. It's incredibly fragile. Because by their very nature, illusions don't last forever.
And this is the most important point of all. The market's insane valuation isn't tied to real-world innovation or productivity anymore. The whole thing is propped up by one thing: faith. Faith that the money printer will never stop. Faith that central banks will always be there to bail things out. Faith that the party will just keep going. But faith is a fragile thing.
At the end of the day, this is the simple truth. Hitting a few keys on a computer to create trillions of dollars is not the same thing as creating real, lasting prosperity. Real wealth comes from making things, from building things, from coming up with new ideas that actually make people's lives better. You simply cannot print your way to a stronger society.
And that leaves us all with one massive, unsettling question. The argument is that this disconnect, this giant chasm between the financial world and the real world, just can't last. An illusion only works as long as everyone believes in it. So what happens when the belief finally starts to fade? What happens when reality comes rushing back in?